The last important thing to remember about a bond's price is that it has almost everything to do with what investors perceive the value of the current interest rate being paid, okay? Or how investors perceive the value of the current interest rate being paid. And that's this idea of yield to maturity. Okay? When an investor, a new investor, buys a bond, or let's take a different one. When a company sells a brand new bond, the yield to maturity is exactly equal to the interest payment that they promise, which is called the coupon rate or the coupon payment. Right? So the company sets the coupon based on what the prevailing market rate is, right? That's the risk-free rate, and the level of risk that investors assume the company is going to have going forward. Right? That's the risk premium. So they calculate what those are on the day that they're issuing. They add them together, and for UPS we say, okay, we're going to issue this bond at a 5% coupon, which means 5% interest. And that's based on the current risk-free rate and the current evaluation of UPS's risk for however long the bond is going to last. Now obviously the risk of a, say, 30-day bond, which it doesn't exist for companies, but it does exist for US government bonds, but it doesn't exist for companies. But just as an example, of 1 month, the risk of UPS going bankrupt and not paying me back is almost nothing. It's pretty low, right? But the risk of UPS in 30 years going bankrupt, well, that's a lot more significant. So the coupon is going to be determined by this built-in risk. Right? Now, as time changes, all of those things also change. Right? So if I buy a bond today, a brand new bond from UPS that expires in 15 years, I have to know that whatever I'm willing to pay today is going to be different than what I would be willing to pay, say, 2 months ago, and it'll be different from what I'm willing to pay, say, 2 months from now, right? Because the risk-free rate is going to change, right? So if we go back to our example of, let's say UPS sold a bond in December, 10-year bond in December. They probably got a really good deal on it. They probably are paying 3-4% interest, and they're feeling pretty happy about themselves right now. Of course, that was based on the risk-free rate in December and on investors' perceptions about UPS's risk in December, which were great. The economy was healthy. People were buying tons of things on Amazon. UPS is enjoying one of the biggest, most profitable periods in their existence, and we only expected that to continue. Right? So the rate that we paid in December was purely based on what we thought the future looked like in December. But now we know the future is not as bright and rosy as we expected it to be. Right? The rate that UPS would have to pay now incorporates a significantly bigger risk factor, which is that the crisis has shut down the economy. And even though if we are buying things, we're buying them online and getting them shipped, lots of us have taken a financial hit from jobs lost and income reduced and things like that. And even if we haven't done that, we're being more cautious about the way that we shop and spend because we don't know what the future looks like. So we're just having less things shipped and delivered. This is going to be a big hit for companies like FedEx and UPS. That means that my estimate of the risk of their business going forward is significantly higher. They are a more risky business now. And so I'm going to charge them a higher interest rate if I were to buy a new bond from UPS today than I would have if I bought one of their bonds back in December. Okay? This idea that the risk changes over time, it also means that the value of those older bonds has changed over time, right? The bonds that UPS sold in December were a great deal for UPS, but now that we investors have re-estimated UPS's risk, those bonds are looking like a really bad idea, right? I am allowing UPS to only pay, say, 3 or 4% on those bonds because I signed a contract. Remember, a bond is a legal binding contract. I can't get out of it. I can't change the terms. If I bought one of their bonds in December, the only way I can get out of the deal is by selling the bond in the open market. And who's going to want to buy this bond now that investors have re-evaluated the risk of UPS and decided that that risk is significantly higher than what we thought 3 months ago? Well, nobody. Because I won't be able, especially not if I'm trying to sell it at what I paid for it. And what I paid for it, what you pay for any bond at the time of issuance, is the face value. Remember, this is a loan. Even though we're talking about selling and buying, this is a loan. So when I buy a bond, I make a loan to a company. And the face value of the bond is precisely the amount that I loan to the company. So I buy a bond from UPS for $1,000 by loaning them $1,000. They give me the bond that I purchase. And then at the end of the loan's contract, at the end of the bond's life, they give me my $1,000 back. And in the meantime, they paid me all the interest. Right? So it's just like a loan. It just has this sort of weird buying and selling trading terminology baked into it. But 3 months ago, I loaned UPS $1,000. So I bought this bond for $1,000. And 3 months has gone by, I would want to be able to still try and sell it for $1,000. The problem is everyone's reevaluated the risk, and they all think that 3% interest is not enough to justify the current risk that we know UPS faces. So it's not as valuable of a bond, and the only way for me to sell a not very valuable bond is to reduce the price. I have to sell this bond for less than face value. And the reason I do that is to encourage a new investor to buy the bond. And the reason why a new investor might be willing to buy a bond at a lower face value, even though it has an interest rate that isn't high enough to justify the risk of the company going forward, is because when the company pays back the bond, they will pay back the face value. So if I buy this bond from somebody else, and I pay them, say, $900 on a $1,000 face value bond, not only will I collect all of the interest payments for the rest of the life of the bond, I'll also collect the $1,000 face value when UPS repays the bond at the end of its life. So I'm going to make money not only from interest, but also because I bought the loan at a discount, and the loan will still be paid back in full. Remember, it's a contract. UPS can't get out of it any more than we can. And that price gain that I'll get at the end, that is enough to bump up the effective interest rate that I'm earning on the bond, the effective return on the bond. Right? If I buy a bond at $1,000 and I get my $1,000 back, my return is just the coupon. It's just the interest rate. If I buy a bond for less or more than the face value, the return is both the coupon and this price difference. And that idea that there's a price difference and a coupon, that's what we call the yield to maturity. The yield to maturity is the effective return an investor would earn if they bought the bond at its current price and held it till maturity. They would get whatever this price difference is, plus they would get the coupons that are promised. And the coupons are fixed, so those don't change, but the effective rate that I would earn would change. And that's why this is a really valuable tool for thinking about the firm's cost of debt going forward. Because this has now built into it, whatever the current yield on the firm's debt is now got built into it this additional risk that we have assessed with UPS based on the current economic cycle. Right? So it has the baseline rate, it has the old risk, and it has the new risk all baked into one effective rate. And so if I can observe the firm's current prices, then I can calculate the firm's current yield to maturity. And that is the rate that a firm would have to pay today if they issued a brand new bond. Okay. So a couple of things are important here, but mostly that's what's at play. And we can solve this formula in our financial calculator. You can solve for the present value. You can solve for the yield to maturity. You can solve for it in Excel. You can do all of that together, right? If this all sounds like Greek to you guys, go back and look at your notes from the intro class. I've got slides from my intro class posted at the bottom of the lecture page, so you can go look at those slides. You can refresh yourself, go look at the bond chapter, and walk yourself through the bonds, okay? This is an important thing, and you'll need to be able to solve for yield to maturity, so make sure you know what you're doing. Okay. Now, so let's go back to what do I need when I am trying to estimate the term for cost of debt. The first thing I need is prices, because I need to value the market. I need the market value of the firm's debt, and then I need the yield to maturity, which is the cost of debt. So the first part, the price of the firm's bonds, is incorporated into value because just like with equity, what I need to do to calculate the market value of debt is I look at the price of the bonds, I multiply by the number of outstanding bonds. That's the market value of my debt. Okay, so I know that there's going to be, the prices are going to be around 1,000 because that's the face value of a bond. But the price might change, and it's going to change depending on how the interest rate in the market changes and how my perception of the firm's risk changes over time. All that being said, it's actually pretty straightforward to calculate the price of a bond because we know what bonds exist. We know what bonds are outstanding, and we can observe them all.